Hello, everybody, and welcome to the latest SFI Live. We're having some technical difficulties trying to get Peter on the line. So I'm at the moment joined by our usual suspects, so Holly Andrews and Tony Hall from Stafford Building Society. We are trying to get Peter on. Fingers crossed we will. So in the meantime, we're going to be just discussing criteria, I think. So let's work our way through a few questions, and fingers crossed we'll have Peter with us very, very shortly. So let's talk about the new budget. Tony, this is what I'm going to throw at you. So the budget's come out. The government are promising first-time buyers a 95% and a guaranteed. You refrain from using that normally, but a guaranteed mortgage. How is this going to work, and what does that mean for you as a lender compared to the panel of lenders that they put into their documentation?
Well, as I said, we're kind of looking. Our product team are looking into the mortgage guarantee scheme from the government. So I think initially the idea is it's going to be with those mainstream lenders that were, identified within the budget documentation. But in essence, it's a 95% loan to value product for first time buyers. In fact, not just first time buyers. It's anybody really, which is fantastic, and we've already seen the impact. So. Two lenders have already come out with a 95% product outside of the scheme, which I think was Bank of Ireland and Accord. I can see that Peter's joining us, which is brilliant. I can pad for a bit longer than the main acts here. Which is, so I think it's already stimulated the market in terms of lenders feeling more confident. The problem has been that because it's such a big area and needed, that when lenders were coming out on their own, they were getting utterly swamped, and therefore were picking up the volume very quickly and not being able to service it effectively. So there's been a bit of a nervousness. Obviously now with more lenders and this government scheme opening up, it creates a more competitive landscape, and more lenders will want to be in it because it's just more choice for consumers and for brokers as well. So I think that's a real positive. And interestingly, obviously, we've been in 95% all the time, albeit it's in our joint borrower sole proprietor product, but we are at 95%. And we are obviously assessing the opportunity to come back in a more, standard capacity in that area. So I think that's the good thing about the budget in that point. The other big thing is obviously the stamp duty extension, allowing more people to take advantage of the opportunity to buy their first house or second house without such a large tax bill. So, it's still going to create a cliff edge at some point when the scheme stops. So everybody's had a sigh of relief, but we're seeing how busy we are now for customers wanting to complete by the end of March. Obviously, it's not such a panic if they don't, but, we are focusing on completions in this period to enable people to do that. So those are the two main opportunities, I think, from the budget.
So now Peter's joined us. We'll jump to Peter in a second, but let's just pick up on the JBSP conversation, because it's one we've had before, and it's a great product. It is 95%. Holly, do you want to give the viewers some details on what the JBSP is?
Yeah, definitely. So it's one of our first-time buyer range, and it's available to applicants that are struggling with affordability and have a smaller deposit. And when they're struggling with affordability, they may need a supporter to go on the mortgage to help them. So that could be the likes of, mum and dad, grandma, granddad, aunts and uncles, but it also goes to step parents, foster parents, and again with the grandparents as well. So what we're looking at is that the first-time buyer can cover 70% of the loan size applied for, and then the support then covers the 30% shortfall of that borrowing that they're looking for. And then what we're looking at is that the first-time buyer has the ability to remortgage and refinance in the next 5 to 10 years as their salary increases to remove the supporter. So it's just we'll be looking at, you know, what's their career track, what they're looking to do, and things like that. So yeah, our JBSP has proven popular, but the benefit that we have with our product is that it doesn't restrict the term. So we don't restrict the term based on the supporter's age. We, in effect, could offer a 40-year term to the first-time buyers. The supporter can just be no older than 70 at the time of application.
Okay, brilliant.
So, yeah.
Right, so Peter, welcome. Welcome to SFI Live. We're here eventually. So let's talk development finance. So Peter, in the most succinct way that you can you explain to us what development finance is?
Yeah, sure. I'm delighted to. I think the key is that it's lending to somebody who's building a property to sell it. Now, you could expand that further. They could be building it to actually retain it for an investment. But, you know, the development side is purely, it's to build a property that people aren't going to live in. And the reason for that is that if it's going to be a property to live in, then it's a regulated loan, and it's something which Tony and Holly and their teams look at, but we don't look at. But we lend to developers and to small house builders, predominantly in the southeast, although that's not cast in stone, but predominantly in the southeast, for people who are either building maybe a small estate of houses, or they're converting a large house into apartments, or an office block into apartments. May even be a barn conversion, something of that nature. But their aim, once they've built it, is to sell it and to obviously take the gain and hopefully move on to something else, which we can then talk to them about in the for the recycling the money. Okay,
so these are very much build to sell. Is there a minimum plot size, or you said about barn conversion? If you're turning a barn into 5 flats, for instance, is there a minimum, a maximum?
Yeah, no, there is. I mean, I suppose the key criteria should be that the GDV, that the gross development value, in other words, the value of the project when it's completed. If it's more than £5 million, it's unlikely to be something that we can look at. And the reason I say that is that our lending criteria is that we lend between, bless you, a minimum of 500,000 and a maximum of £3 million. So if you work on the criteria that if somebody's borrowing the maximum amount from us, the 3 million, then at 2/3 of the GDV, 5 million is likely to be the top point. So they're relatively, in the widest sense, they're relatively small loans. But within that, it does cover a multitude of sins. It could be, as I say, it could be five houses on a piece of land where they're building, 5 decent sized detached houses, or it could be a manor house that's been converted into stylish apartments, for example, and anything in between. I think one of the USPs that we do have is that we're comfortable in lending in that 500 to 1 million category, which I have to say that we're probably, I wouldn't say we stand alone, but there aren't many of our competitors who actually operate in that marketplace.
But it's not just cash, is it? It's not like you don't just suddenly chuck the money at them. This is a staged process.
Yeah, very much so. And I think this is where it differs from, say, a self-build or even if somebody's doing a light refurb, because on the self-build or the light refurb, the money tends to go out in stages. Perhaps when the property's got the roof on, or when it's watertight, or at first fix or second fix. Because the majority of most of the lending that we do, in development finance, is where a independent contractor has been appointed to build out the project. It means that the cash flow and the release of funds is very much reliant upon what the the contractor's cash flow is. And I say that from the point of view that, you know, if you're a contractor that's been appointed to build, build a housing estate, you'll want to get paid at regular intervals, either monthly, usually monthly, sometimes fortnightly. And that means that at every one of those pinch points, every one of those monthly pinch points, a monitoring surveyor will need to go out and to monitor the works to release the funds. So, you know, over a project, say for 12 months duration, you know, there could be 12 interim drawings, for example, which is rather more than you'd get from a self-bill, where you might only get, I don't know, 3 or 4, shall we say, something like that. So, but yeah, the money's released against the monitoring surveyor's certification of the works, and that's an additional cost, which you know, somebody who's costing out a project will obviously need to build into the budget.
So we're talking to mostly brokers here. So let's talk from a broker perspective. What does their client have to have from an experience perspective, finance perspective, to launch their project? What do they have to have in place in order for you to seriously consider them?
Experience is very much a key for us, Jay. And I say that from my experience, you know, being involved in this market for donkey's years. And the more experienced you are as a developer, in my opinion, the better chance you have of completing a successful project. And I say that because there's so many pitfalls that befall a development. You know, I've lent, for example, to very successful contractors who are excellent at building houses, but they come to me as a first-time developer. And there's all sorts of different skills that a developer brings to play that a contractor won't have had to deal with, or probably won't have had to deal with. And I think of one example in particular. At the end of the day, the project was successful, but it overrun quite dramatically because of issues which an experienced developer would probably have been able to deal with at the outset. Problems with planning, problems with neighbours in terms of in terms of party wall issues and that sort of things. And dare I say, problems with contractors, you know, that they can take some managing at times. So, you know, all of those things mean to me that if you're experienced, you're likely to have gone through that process and been able to deal with that process. So, you know, I'm not saying we'd never lend to an inexperienced developer, because never is a heck of a long time. But the likelihood is that we'd want somebody who's done it before and has gone through the pain of doing it before and knows what that brings. So that's the first thing, experience. Second thing is they need to bring some cash to the table. You know, I mean, the way that we structure our lending is we lend at the lower of either 65% of the GDV or 75% of the costs. And in that little criteria, it tends to be 75% of the costs, which is the lower. But, you know, if it is 75% of the cost, then the guy we're lending to needs to put 25% in himself. And that 25% can come in at the start when he's buying the land. It often does. They're buying land and that's where the contribution goes in. But it could well be that their contribution needs to come in a bit later in the project. So, you know, we like people who've got access to some liquid funds in case they need it. And I say that because most projects tend to overrun in terms of either cost or time. And if it overruns in time, it means it's more cost, you know, obviously with interest payments. So that's not to say we won't look at funding cost overruns further down the scheme. And we often do. The majority of the time, I would say we do. But, you know, it's not a given that we will. So if the borrower's got the cash, it's always cheaper for him to use his own money than you to use our money. The third thing is make sure you've got all the ducks lined up. I mean, you know, planning is a myriad of problems in planning. You know, even ourselves, if we're looking to put, you know, an extension on the side of the house, you know how difficult it can be to get these through. So make sure the planning's fine. Make sure there are no major issues in there you know, and if you're looking to enhance planning, have the conversations early on with the planning people, get a pre-app if you can, pre-approval, you know, from the planners, which isn't a given, but it's gives a, you know, a fair amount of certainty that it's going to be available. It's doing all those things right. If you can do those things right, then the project that you present to us is likely to get, you know, to get well received.
Okay, so there's not to take out of that. There's a hell of a lot. No, you and I have had conversations previously about, you know, when it comes to planning, you know, it's not as straight laced as everyone always thinks it is, and certainly from if a broker is having an inexperienced developer coming to them, what could they potentially not foresee about their planning?
I mean, a lot of the things actually can come in, you know, after the project started, and I say that because one of the things that I'm seeing on a lot of planning projects now, planning approvals now, is you know, archaeological sort of searches, and you know, even the most which, you know, if you're in, you know, if you're in places where there's been Roman settlements or Saxon settlements, then, you know, obviously it's very important that these things are undertaken. But at the end of the day, the searches are only ever going to provide almost an indication or even a guess at what's under the ground. You know, once your developer comes in and he starts digging down 6 meters, you know, you find a Saxon hoard, which of course in its own way would be a bonus to the block, no doubt. You know, it will hold up the project, you know, and it's the unknowns that can be there. Let's
throw out the subject you and I discussed last month, the rights of light.
Yeah.
Because I couldn't get my head around it. It took me a little while to understand what that process was and what it meant. And the fact it could be a utility room, you know, a room you don't use very much, but actually they can take that into account, you know, as a rights of light. So explain that a little bit to the guys, because I think they'll probably appreciate that.
This is when we were talking about what we were talking about, gross internal areas, were we? Or?
Yeah. So the view of light, the access of light, and you know, certainly more kind of, what's the right word? More urban builds, and you know, the rights of light in there, and that ruling and what that means.
I remember now. That was an interesting issue that turned up, and it only turned up when the valuer went out to see the property. Property was being built fairly close to a neighbour's boundary. But within, you know, it didn't impinge any issues in terms of impinging the boundary or anything like that. There were no party wall issues. But the way this property was being built, it was going to throw a shadow onto the adjoining property, and because of that, a right of light survey was called for, and it held back the project. I mean, the project was the lending was due to draw down, and this only came out when the CO, the COT, the certificate of title was being prepared, and it meant that the thing was held back for at least another month, 6 weeks, until this was sorted out. And at the end of the day, the surveyor that went out to do the right of light surveys, you know, confirmed that it would provide detriment to the neighbours. And the poor developer had to put his hand in his pocket and pay quite a sizable sort of out of pocket cost to keep the neighbour quiet, quite frankly. And
it's one of those things that just doesn't come up in your general plan, does it? Like, you know, when you go to planning and you go through all this process, one of those things that just gets thrown at you afterwards. You know, whoa, I don't even know what this is. And so it's really important we do that. We have got some questions in, so bear with me. So Chris Warner, Peter, if you can't answer any questions, feel free to say, don't know the answer, and we'll go back to someone by email. What's the maximum LTV for day one and the maximum percentage of build costs, stroke the maximum against GDV, please?
Yeah, on day one, Jay, we would lend up to a maximum of 65% of the land value, or the purchase price, if they're, whichever's the lower of those two, which then tends to mean that, that's where your borrower contribution comes in. They're putting the cash in to make that work. But our overall criteria is 75% of the costs or 65 of the GDV. That tends to mean that overall we can usually fund, 100% of the build costs. I can't guarantee that on every scheme we do that, because no two schemes are entirely similar. But if we can't do 100%, it's usually in the 90s, 90-95% of the build costs. And I think that works quite well for the borrower. It certainly works well for the lender that we get the cash in early, get the contribution in early. And if the borrower then has the comfort of having, all or most of the build costs covered, then I think that gives them quite a good, a good product.
Okay. Lisa, I presume I'm pronouncing that right. A couple of questions. What professional fees will be included in costs, and do you include your arrangement fee? Oh, it's just jumped. Arrangement fee, finance costs, legal fees, and broker fees in costs?
Yes. In terms of fees, there are three fees which have to be paid, being our legal fees. We employ our own independent solicitor to do that, the valuation fee, and the QS fees. The way that, and in terms of what they are, it's obviously every scheme's different, but usually the valuation fee is around about 1 or 1.25% of the GDV figure. Legal fees tend to be round about £5,000-6,000. It's that kind of figure for a say £1 million sort of project. And QS fees, again, going back to what we were saying before about the number of times the QS comes out, the monitoring surveyor comes out, these could be £10,000-15,000. So they're all costs that need to be added to the budget. In terms about how they're paid, the only cash payments that the borrower would be required to make are, first of all, the valuation fee, because at that stage we haven't got a relationship with the borrower, so we ask them to pay the valuation fee up front. I don't think that's any different to many lenders. As for the other fees, yes, they can be added to the overall cost of the project, and yes, in principle, they can be released at stages during the project. Once invoices are provided. The arrangement fee we tend to add to the loan, and even to the extent that if that takes the initial GDV, loan to value over the 65%, it may take it to 66% if we've added the arrangement fee in. But most people want the arrangement fee covered by the loan. I'm happy to do that.
Okay. Lisa's come back again with another question. I'm dealing with more and more developers who purchase land via an option once they have secured planning. If advancing funds towards the initial purchase of land, would you base this upon the price guaranteed or value having obtained planning? The difference can, of course, be substantial.
If in terms of the amount we release on day one, it will be 65% of whatever agreed value has been agreed for the purchase price. That won't change. But if they've enhanced the value by during the option period by securing better planning, then we'd use that figure to calculate some of the later figures in the project. Because, for example, every project has got to be profitable. else there's no point the borrower doing it or us lending the money to do it. And you're going to use the enhanced value to work out the profitability. Of course you are, or else it's never going to be it's unlikely to be a profitable project. So yeah, we're happy to use the enhanced values, but not on the day one release. The day one release will be based upon the pure value of the purchase price of the land.
Okay, brilliant. Lisa, I hope that answers both your questions. If you've got any more questions, please pop them in the chat box. Steve Walls has asked, do you require collateral warranties and SEPRAP on legals?
Yes, we do. But we don't on every project. I mean, we do take a view on these things. But if somebody's building a significantly sized project, and by that I mean anything probably from 750,000 of debt upwards, then we would expect to have collateral warranties from those with a design responsibility. So that's the architect, structural engineer. If they're building a basement, the basement membrane supplier, and maybe even the piler if they're piling the land for the for the substructure. So it's those kind of people that we would look to. For smaller projects, we'll take a commercial view on things, to be honest.
Okay. Lisa, our pleasure. Ray has private message. No worries, Will. There'll be recorded versions of the webinar available by 3 p.m. today, so we'll send you a link. Don't worry. So, Peter, just because the majority of our viewers are brokers, what advice can you give them to encourage business from SME developers? What do they need to say? What do they need to portray as a broker? I think it's a different environment. I presume most of your clients are direct clients. So, for these guys, how can they deliver this in a way that will make it business beneficial to them?
No, it's a great question, Jay, and you're right. I mean, a lot of our business is direct, but I'd like to do more with with introducers. It widens the reach and widens the scope. I think for me, and I say this, I've been in this industry for a long time, but it's not, there are various myths about development finance, that it's complicated, and there's all sorts of weird and wonderful expressions that are used, and so on and so forth. But I mean, truthfully, it isn't. I mean, if idiots like me can be in this industry for as long as I have, then there's no reason why anybody else shouldn't be, quite frankly. I put it down to the basics, that if you can do the maths, then it works, because most of our criteria is based around lending against a number, whether it's lending against a value, whether it's lending against a cost, and if we can make sure that we fall into the right criteria for that, then development finance is relatively easy, in my opinion. So in terms of the borrower, I think in terms of the broker, I think if they wanted to widen the reach, then I would just say, look, we're open. We're genuinely open for business. I'm approachable at any time people want to make contact by phone or by LinkedIn or by email or by text or whatever. If you've got the inkling of a reasonable development case, then just pick the phone up to me. We can discuss it within a minute. We can decide whether it is or it isn't going to be something that's got legs. If it's got legs, then we can start the process, and then it's an information gathering process. I just encourage people to do more of it. I mean, I'd love to be dealing with a lot more introducers than we do, and if this medium provides an opportunity to do that, I'd be thrilled, absolutely thrilled.
I think it stands by what Holly, Tony, and I have said all the way through, is Saffron is a case-by-case business. Everything we do, everything we talk about, everything we deal with is let's look at this and we'll tell you an honest answer. We'll give you an honest approach. And I think this stays the same here. We've got a few questions come in. What are the typical terms, i.e. interest margin, arrangement fees, exit fees, and maximum term?
I mean, I can talk about fees more easily than I can talk about margin, and I'll come on to the reason why at the moment. In terms of fees, we're likely to be charging a 2% arrangement fee, which, you know, if the broker's FCA registered, then we're happy to share that with them on a 50-50 split, and a 1% exit fee. The interest rate depends upon all the variables that we talked about earlier: the experience, the location, the type of development, the type of house, or the type of development the borrower's doing, and all those sort of things. Those sort of things go into the mix. But all I would say to the inquirer is that when you add all that together with the arrangement fees and the exit fees, our overall pricing is going to be very much in line with the pricing of our competitors. So we're not going to be massively out of line with the likes of Hampshire Trust, Close Brothers, UTB, and the rest. Really, we're all very much going for the same market. So we're not an outlier when it comes to our pricing. But I can't give a specific pricing because I won't know until I see the dynamics of the project.
Oh, that's fair. That's fair. So Chris has asked again: is the exit fee based on loan amount or GDV, please?
It's on the loan. It's on the loan amount.
Okay. Michael Wilkinson, sole trader builder looking to buy land with permission to build one house. Would you lend if he is to run the project himself?
In principle, if he's got the experience, if he's done it before, and again, if all the other things about location and planning come into play, in principle, it's something we'd look at. Yes, definitely.
Okay. And Roy Mason, do you appoint your own MS to oversee the build?
We do. We've got a panel of monitoring surveyors that we would pick from, and we always, we always get quotes as well. So we won't just say you've got to use this firm, or that firm. We'll get a couple of quotes, at least a couple of quotes, so the borrower, can basically choose from the names on the panel. We do the same with the valuation panel as well. We choose from several different service providers.
Brilliant. Okay, we've got 5 minutes left. I feel, Pete, you've been bombarded with questions. So I'm going to throw the field out a little bit while we've got the last 5 minutes. So Holly, at what point, these are, most of these brokers you would have spoken to or you deal with day in, day out, at what point do you go, okay, this is not me, this is Pete?
Yeah, so I think for us, as soon as we know that they are building it, so of course we deal with self-builders, BDM team, so they're building it to live in it themselves. So as soon as we know it's not for that purpose, we know the expertise is definitely left with Peter and his team. So I don't know, Peter, you get the same for us. You get our self-build ones, and they should be coming to us. So yeah, definitely approach the BDM team if it's for them to live in themselves. Anything else on development side is definitely Peter's area.
It's a clear line, isn't it? If you're building to sell, if you're building to live, it's a very clear line in my mind. So I think we all need to be aware of that. That's where the line is.
And I think we can improve that message on our website. To be honest, I think our website is, and I think the website's good, but I think we could actually make that message as maybe even a strap line.
Yeah,
where people go in there.
Pete, I was just thinking the same thing. It's so easy to split off and go building to sell, building to live in. So we'll take that away definitely. So I think there's a good opportunity there, and as you said, it's a nice strap line as well. So
it works really well, doesn't it? So you guys, you've got exactly 3 minutes to come back to any questions. Feel free to throw anything you want us on criteria or anything else. So. Peter, it's the first time you've joined us. It's been an absolute joy to have you on. Is there anything you want to say that will help the brokers? I mean, we've gone into detail. The majority of the 34 people that are currently online with us live at the moment will be brokers. What advice can you give them? What would you like to say to them? How can we close this nicely for you?
I think I'd go back to something we said, a bit ago, really, that, there's no mystery to it. It's not something to be, to be afraid or unsure of. And, we're not monsters. I mean, you pick up the phone to us and talk to us, have a Teams call with us or whatever. And we're very happy to put the time in. I mean, it's a learning process, I think, for everybody. And if you're inexperienced introducer in this field, then the more it's the old Gary Player thing. The more I try, the better I get, and the more opportunities there are to have conversations with the likes of me and other guys in my team, then the better chance that we've got of having some of these potential cases that actually drop, and if they do, then there could be considerable rewards, because, as I said, we're happy to pay 50% of the prop fee to the introducing the introducer. So on a £2.5-3 million deal, that can be not inconsiderable amount of money.
Not a small amount of money. Brilliant.
If we go on holiday, pay for a holiday with it, but.
So, Tony, Holly, you haven't had much chance to talk, so I'm going to throw this out. Why don't you introduce your new team members to us? Who's going?
So I missed that. Sorry, it just broke.
Sorry, my mouse fell off a desk. I do apologise. Why don't you introduce the new team members to us? So we are just about to go out with an introduction to the press, but we've got team members, haven't we?
Yeah, well, I mean, Holly's grown her team as well, but I'm delighted that we've had a lot of feedback from brokers in our 6 monthly surveys, and in fact we've just started real-time surveys with brokers now, which is another development. So every time a case gets to offer, we will be sending out a survey to that broker to say, how was the experience? We really want to learn from that, and the amount of changes we're making as a result of feedback. But one of those was, we want to see more of you, so we've started to grow the team. So I'm delighted that from the 1st of March I have 2 new BDMs. One a very experienced chap called Phil Lawford. A lot of people will know Phil because he's been around forever, but what he doesn't know about the market isn't worth knowing. So he's a massive win for us, and he's already out there speaking to his contacts, bringing making things happen for us, which is brilliant. On the other side, we've got Simon O'Donnell, who's joined us. He's an internal move. So Simon has been successful in our branch network and sales and service teams, and really has a great eye for mortgages, and therefore we're giving him a huge opportunity to join the BDM team in the south. So again, we'll be, as you've said, Jay, we'll be announcing in more detail. But 2 on the team now. So when I started in July, the intermediary team was 2.5. We're now up to 7. So we're growing those numbers, and that will continue throughout this year and beyond, because it's what our brokers are asking us for, which is great.
And I think that's a really important message, is the listening. And if you have a comment or something you want to say, you've all got the details of Holly and Tony. Holly, do you want to give out? We always do this at the end of everyone. Give out the email address and phone number for the brokers.
Yeah. So for the BDM team, for phone number, it's 07. No, completely wrong. It's a good start. It's 01799582925, and the email address is bdm.inquiries@saffronbs.co.uk. And since we last spoke on the webinar, we also have live chat available on our website now. So that is the BDM teams in the background running that as well. So any criteria-based questions, you can also use the live chat, that you'll get a response nice and quickly too. So yeah.
Intermediaries.co.uk, isn't it? So
yeah, and it'll just pop up in the bottom left-hand corner. Say click to that.
I've seen it pop up. It's highly active. And Peter, just because you are new to this and you have direct contact details, what's your email address, please?
Yeah, it's development inquiries. That's without any full stop or dash. Development inquiries at saffronbs.co.uk. And the number is 01799 582 886.
Brilliant. Well, that's it. That's all we've got time for. That took up more time than I thought it would, to be honest. Peter, it's been lovely to have you on. Great addition to the team for today. Again, Tony, Holly, as always, thank you. anybody who wants to watch this on demand, we've had a few private messages. It will be available from 3 p.m. today, and we'll put it up onto YouTube as well. All right, thank you so much, guys.
Fantastic.
Thanks, Jay. Thanks, Peter.
Bye.
Take care.
Take care.
Bye.
Bye.